Welcome to this explainer. If you aren't a salary here in India, the Income Tax Act 2025 has laid out some very specific rules that literally dictate how much of your hard-earned money stays in your pocket. Today, we're diving into a masterclass on the salaries head of income so you can legally and smartly minimize that tax burden. Let's get right into it.
Now ask yourself honestly, are you sure you're not calculating your taxable salary wrong? The tax code is just full of hidden traps, from double taxation nightmares to completely missed deductions. Well, today, we're going to expertly navigate those traps together, block by block.
Here's our structural blueprint for today's explainer. We'll be covering 1. Scope and triggers, 2. Prerequisites and substitutes, 3. Exemptions and deductions, and finally, 4. The final synthesis.
Starting off with Section 1, Scope and Triggers. Okay, so Section 15 governs the basis of charge, and the golden rule you absolutely need to remember here is whichever is earlier. Basically, you're comparing the due basis, meaning it's taxable whether it's been paid to you or not, against the receipt basis, which is taxable even if it's not actually due yet. But hey, watch out for the double taxation trap under Section 15.3. If you get taxed on an advance salary when you receive it, you won't be taxed on it again when it eventually becomes due. Oh, and a quick side note, if you're a partner getting remuneration from a firm, that's not salary. That actually gets charged under business income.
Moving on, Section 16 gives us this incredibly broad, inclusive definition of what salary actually means. It's a massive umbrella. It wraps in everything from your standard basic wages, annuities, and gratuity, all the way to modern additions, like the Ognivir Corpus Fund under Section 125, Section 124 pension schemes, and recognized Provident Fund accretions. So yeah, it is way more than just your basic pay.
All right, moving right along to Section 2, Perquisites and Substitutes.
Now, Section 17.1 is where we get into your perquisites. For core additions, think ESOPs or sweat equity. Remember this one absolutely critical rule. The fair market value is determined on the date the option is exercised, not the grant date. That's a huge distinction. Also, you've got to watch out for what we call the specified employee trap. Free or concessional benefits suddenly become taxable perquisites if you're a director, if you have a substantial interest in the company, or if your monetary salary crosses certain prescribed thresholds.
7,50,000 rupees. Make a mental note of this number, because crossing this exact threshold triggers one of the most common and, frankly, most costly tax traps for high-earning professionals under Section 17.
So here is exactly how this trap works. You have to aggregate your employer's contributions to a recognized Provident Fund, Section 124(1) schemes, and approved superannuation funds. If that combined total breaches the 7.5 lakh threshold in a tax year, bam, the excess is a taxable perquisite. But here's the real kicker. We call it the domino effect. The annual accretion, meaning the interest or dividend on that specific excess amount, is also taxable as a perquisite. It really adds up.
Thankfully, it's not all bad news. Section 17.2 steps in with some much-needed exclusions. Things like your health insurance premiums, or using an employer vehicle strictly for your residence-to-office commute. Those are totally safe. Medical treatment in employer or government-approved hospitals is excluded too. But if you're looking at foreign medical travel, well, the rules get super strict. Medical and stay expenditures are excluded only to the extent permitted by the RBI, and the actual travel expenditure is only excluded if your gross total income stays below the prescribed limit.
Then we have Section 18, which covers profits in lieu of salary across your entire employment timeline. We're talking lump sums you receive before joining, keyman insurance payouts during your employment, and termination compensation when you eventually leave. The catch here is that Section 18 explicitly excludes specific scheduled payments, like gratuity and pension. And actually, that brings us perfectly into our next vital section,
which is Section 3, Exemptions and Deductions. Let's look at how to bring that chargeable income down.
When it comes to your standard deduction, you always need to verify your tax regime first. It's a split path. If you've opted for computation under Section 2021, you get the upgraded 75,000 rupees deduction, or the amount of your salary, whichever is less. For other cases, it's the standard 50,000 rupees. So definitely check that first. Oh, and don't forget, professional tax is fully deductible, but only if it's actually been paid out of pocket by the assessee.
Now, let's unpack the master matrix for gratuity exemption. If you're a government or defense employee, congratulations, you are fully exempt. For employees covered by the Payment of Gratuity Act, or POGA, your exemption is restricted to those specific statutory limits. But for other employees, it gets a little bit more complex. Your exemption is the minimum of 3 amounts. the actual gratuity you received, the government notified limit minus any past exemptions, or the formula of half a month's average salary for the past 10 months multiplied by your completed years of service. And remember, when we say salary in this specific calculation, we strictly mean basic plus DA only.
Next up on the matrix is pension commutation. Once again, central and state government employees, defense personnel, and a few others fall into the 100% exempt group. For non-government employees, though, you face another split path based on one very simple question. Did you also receive gratuity? If the answer is yes, only 1/3 of the normal commuted pension is exempt. But if you didn't receive gratuity, you get a much more generous 1/2 exemption.
Leave encashment follows a really similar pattern. Government employees get the entire amount exempted upon retirement. Easy enough, right? Non-government employees, however, have to test their payout against the minimum of 4 distinct limits. First, the cash equivalent of earned leave. Second, 10 months average salary. Third, the government notified limit. And fourth, the actual payment received. And just like with gratuity, salary here means absolutely nothing but basic plus DA.
Finally, Section 19 also details relief for retrenchment and voluntary retirement schemes, commonly known as VRS. Now, retrenchment relief relies on calculations per the Industrial Disputes Act, but pay close attention to VRS. This is a strict, once-in-a-lifetime exemption capped at 500,000 rupees. It requires strict adherence to economic viability criteria, and here's the catch. If you claim this deduction in one tax year, you cannot claim it in any other tax year, period.
And that brings us to Section 4, the final synthesis.
This right here is your master formula, the ultimate salary blueprint. First, you aggregate your basic salary, taxable allowances, profits in lieu, and the value of any perquisites. Boom, that gives you your gross salary. From that gross salary, you subtract your standard deduction, so either the 75K or 50K we talked about, along with your professional tax and any specific Section 19 exemptions you qualify for, like gratuity, leave, pension, or VRS. The mathematical figure you're left with, that is your final income chargeable under salaries.
As a professional pro tip, please beware of a few critical traps before you finalize your numbers. First, the A minus B aggregation trap for gratuity and leave encashment. You absolutely must deduct past exemptions if you've changed jobs over your career. Don't try to grant yourself the full limit twice. Second, always run that 7.5 lakh limit check on your combined employer contributions. And third, keep in mind the shifting definition of salary. Honestly, it's a chameleon. For the standard deduction limit under 221, it means your gross. But for gratuity and leave encashment, it strictly means basic plus DA.
So will you let that shifting chameleon definition catch you off guard next tax season, or will you use this blueprint to take total control of your taxes? Remember, effective tax planning is never about evading the law, it's about understanding the rules so inside out that you never pay a single rupee more than you are legally obligated to. Thanks so much for joining me in this explainer.